Our moderator for today's panel discussion is Sunil Soares, the founder and CEO of Your Data Connect, the industry's first data monetization platform. And prior to that, Sunil was the founder and CEO of Information Asset, a data management solutions firm. And he spent several years as the director of information governance at IBM. He's also the author of 8 books on data management. So you are in very good hands with Sunil and his panel. And we'll be focusing on a really important, relevant topic today, data monetization. So Sunil, it's all yours.
Thank you, Wayne, and good afternoon, good evening, everybody, wherever you are in the world. Sunil Soares, CEO of Your Data Connect. On the panel today, we also have Doug Laney, who needs no introduction, from West Monroe. We have Alex Scroggins, the CTO of Your Data Connect, and we have Greg Rosetta, who's our Chief Revenue Officer. So what I'd like to do, without further ado, is to hand it over to Doug to set the stage for data monetization. Doug? I think you're on mute, Doug.
Here. Great, thanks, Sunil. And I'm just going to share a few slides here, do a little bit of an intro to the topic for those of you who are maybe a little less familiar with the topic of the concept of infonomics. Let's see, I am sharing the slides now, correct?
It says started screen sharing. It hasn't actually happened yet, looks like.
Yeah, and now I'm frozen on Zoom. So Sunil, why don't you take it away until I unfreeze here?
Yeah, that's fine. And maybe
I'm
we come back
unfrozen
to
now.
Oh, you are? Okay, great.
There we go.
Okay.
All right, we're good now?
Yes.
All right. So hi, everyone. I'm Doug Laney. I'm currently the Innovation Fellow for Data and Analytics Strategy at the consultancy West Monroe, based in Chicago here. And I spent the better part of the last decade as a senior analyst with Gartner, focusing on data and analytics strategy, the role of the chief data officer. And while I was at Gartner, I published the book Infonomics on how to manage and monetize and measure data as an actual corporate asset. And really happy that the book has been well received. I've heard a number of mentions of it at the event this week, so that's really pleasing. In fact, one speaker, I heard him say, he said, the most important piece of information that we have in our organization is a copy of the Infonomics book. So that made my day. Anyway, I'm now with, like I said, with West Monroe, and West Monroe is a consultancy that focuses on, we're a business and technology consultancy. And my role is really to work with clients on helping them understand and drive more value from their data. So just a quick summary of what Infonomics is. Infonomics is, again, this concept of monetizing, managing, and measuring data as an actual asset. By monetizing, we don't necessarily mean selling data, but there are a variety of ways to monetize data. As Sunil's written in his book, and I've written in mine, there are a variety of ways internally and externally to generate value from data. And that's really what we mean by monetizing it. Then there's a concept of managing data, which is, we manage other assets with some incredible discipline, perhaps more discipline in a lot of cases than how we manage our data. And so one of the concepts of Infonomics is that we should learn from and apply asset management principles and practices from other disciplines to the way that we're managing data. And then the third is about measuring data. Last but not least, really, if we don't understand what assets we have and what their value is, then we're really in a poor position to manage them effectively. There's the old adage, you can't manage what you don't measure, or you can't manage well what you don't measure well. And I think, in my travels over the past few decades, I found that because organizations don't value their data, because accounting practices don't allow you to value your data as a balance sheet asset, we data professionals have been in a really bad position when it comes to getting the resources and the support that we need for managing our data as an actual asset. And then I think it follows that any asset that you're not managing well is one that you're not going to be able to monetize well or generate value from. And so for a lot of companies, this tends to be quite a vicious cycle. And the idea behind Infonomics and the work that Sunil and his team are doing is to kind of reverse that curse, to start with measuring data to understand its potential value. And so I mentioned there are a variety of ways to generate value from data. And so we need to be really have our our eyes open and our mind expanded
Right.
to the, yeah, so there are a variety of ways to monetize data, both indirectly and directly, or internally and externally. And organizations just need to be very open to those possibilities. And the methodology behind Infonomics and the platform that Sunil's been putting in place helps organizations think through all of this and eventually get to a dollar value, a monetary value for their data. When we think about data, there's a variety of ways that we can think about really any asset's value. We can think of it in terms of its actual value, or its probable value, or its potential value, and all of those are really really important to drive certain kinds of behaviors. In Infonomics, I detail how to value data in a variety of different ways, starting with the foundational models on the left, where we look at assets, quality indicators and scarcity indicators as a kind of a measure of potential value. We can also get into mapping data to actual business processes and determine its potential value vis-a-vis business functions. And then at the bottom left, we can actually take a look at how does having or not having some data contribute to a revenue stream or improvements of some business process. And then over on the right, all I've done is kind of adapt the traditional ways that accountants and valuation experts value any kind of asset using the cost approach, the market approach, and the income approach. But we've had to kind of tweak some of those models due to some of the nuances of data that I talked about in my session on Tuesday. That data is a non-rivalrous, non-depleting, and progenitive asset. That is, it can be used multiple ways simultaneously. It doesn't deplete when we use it, and that typically using data generates more valuable data. So it kind of creates a flywheel effect. So I'm going to kind of leave it there, and if we get a chance, maybe I'll share and go into some of the actual valuation models. But I just wanted to give you all a high level of Infonomics, really, and how doing more with your data, becoming more data driven, really starts with understanding what you have and measuring its potential and actual value. And Sunil will get into some details on the framework that he and his team have developed to do just this. All right.
Thank you, Doug.
Thank you.
Great. So hello, everybody. And Doug's obviously an excellent resource. He's been certainly helpful to us here at Your Data Connect and to me personally in terms of his knowledge and experience with data monetization. And his wife, Susan, is actually an excellent resource, maybe even better. But so thank you, Doug. Thank you. So we'll talk today about YDC, our data monetization platform. It's got 4 components: a data balance sheet, data valuation, data risk registry, and a data exchange. Now I just have to move the slide. Sorry about that. All right, so enterprises do not always have the tools today, as Doug said, right, to drive and measure financial benefits of their data management program. 48% of companies in the Fortune 1000 category have a CDO, but he or she struggles to extract ROI from data management. So the average organization has 9.7 petabytes of data. That's a lot. The average CDO in a large organization, according to Gartner, has in excess of a $30 million budget. I've met CDOs who've got in excess of $500 million in budgets. And the average tenure of a CDO is, a short and I would say turbulent 2.4 years. And that's the challenge. Now, why exactly are we where we are, right? So obviously the CDO is responsible for enterprise-wide governance and utilization of information as an asset in a data-driven organization. Their challenge, of course, is to monetize the data. So, they need to have tools to view the data as an asset, value it. Clearly, you've got to measure success, but it's a balancing act. In my experience, the average CDO comes in, but then very quickly, the CFO, the CEO want to know, what have you done for me lately? That's really what it comes down to. So having said that, YDC addresses the evolution of data governance. I've been involved in many, many data governance projects over the years. We started out with business intelligence and data warehousing in the late 1990s. Then we moved to master data management, whether it was around customer or product, vendor, other domains in the early 2000s. Then we moved to data governance, right? Ensuring trustworthiness of data. That was in the middle 2010s. But a lot of these data governance programs are on iteration 3.0 or even 4.0 because they weren't able to drive adoption. And the underlying symptom of that was they weren't able to demonstrate quantifiable financial benefits. Now we think about data monetization, right? I would say starting last year. And then increasingly, you start thinking about digital monetization. So not only are you thinking about quantifying the financial benefits of data management, but quantifying the financial benefits of digital transformation. So with one of the organizations we work with, they told us the chief data officer has a $600 million budget. But if you add up the budget of the data management team, the CIO, including cyber, you end up with $2.4 billion in budget. So the problem you have around data monetization really also applies to digital, right? So YDC's got a four modules. The first module is around creating what is called the data balance sheet. So managing a chart of accounts for your data assets and liabilities. We'll talk about that. Notwithstanding, GAAP and IFRS, the generally acceptable accounting principles in the US and IFRS outside the US, clearly accountants would frown on creating a data balance sheet. There are very restrictive use cases where you'd actually put data on your balance sheet, potentially when you paid for it, right? That you probably wouldn't have too many other situations. You want to value data. So you want to, value the crown jewels of your internally generated or third-party data sets. We have an AI-driven data valuation engine that Alex will talk to you about. The point here is an objection I get a lot is, oh, it's really hard to value data. Well, that's great. But if ExxonMobil can figure out how to value oil and gas under the ground, I think as data management professionals, we should be able to figure out how to value data. And we do ourselves a disservice if we don't.
Absolutely.
Yeah, exactly. Thanks, Judith. Then you got to measure your data risks and liabilities. So valuing inherent and residual risk based on mitigating factors using AI-driven risk scoring. So if you think about data monetization, the realization value, you have to think in terms of your growing revenues, reducing costs, managing risk, and improving cash flow. There's four dimensions to sort of where you want to get to with data monetization. I was talking to somebody on the team this morning about a fifth dimension on ESG and how you could use data to really drive an ESG agenda within an organization. So that might be a potential fifth vector as well. And then, Doug talked about this, external data monetization. That's really listing assets on a data exchange. So you value the data, and then you decide, is there a reason why you might want to exchange that data or sell it outside the organization, or even share it within different parts of the same organization. And that's what a data exchange would do. So that's really it. A lot of organizations, when they look at data monetization and they hear it, they always assume it's selling data. No, a lot of it could just be valuing your data and using it better internally. So this is a data balance sheet. This is an example of a data balance sheet at a very high level. So you see, it looks from a format perspective very similar to what a typical 10K, 10 cube balance sheet would look like. So you've got essentially assets and you've got liabilities, right? So the fundamental thesis here is I've got this concept of data management expense. I've got $462 million. So essentially, if I'm the CFO and I'm looking at the data management organization, the question I have in my mind is the CDO accretive or destructive to enterprise value? What is enterprise value? It's basically stock market value plus debt. So what they're saying is, in a draconian situation, let's say I shut down the entire data management organization, turn it to zero. It's never happened, but it shut it down to zero. So now I'm adding in, let's say, $50 million to my bottom line. If I take my price earnings ratio, let's say it's about 8.5, I'm adding $462 million to my balance sheet. So the way the CFO is going to be looking at data, they're going to say the data management organization today, with a $50 million run rate of data management expense and a given price earnings multiple, that's like long-term debt of $462 million that's sitting on my data balance sheet. That's it. So I need to be generating now on the left side, I need to be generating data assets worth equal to or higher that $462 million. And if I don't, then you might end up with a situation where you're data bankrupt, where your liabilities are higher than your assets. So the whole concept of data monetization is to value your data, but then keep finding new data assets and increasing the value of the assets you have through a process of value realization. So this, for example, equipment we've got is 0. This is not the value of equipment you would put in your 401 in your 10K. This is the value of the equipment data. It's the value of your genomic data. It's the value of your vendor data, et cetera. Okay, so that is essentially the way we think about this problem, and then Alex will walk you through the platform and how you could potentially automate it. So from a technical perspective, we've got a data balance sheet, we've got a data valuation module, a risk registry module, and a data exchange module. We're in the process of adding a 5th module around value realization, which is really all about the next best action. So if I'm a data monetizer, what's the next best action in terms of what I need to do to actually monetize data? And there'll be an AI component to that as well. We've got accelerators for different industries, financial services, life sciences. If you go to our website, we literally have an app right now around how you would value your key data elements for the large financial institution rating system, the LFI rating system for the Feds. Life sciences, we have a module around how you would value clinical trials data using Monte Carlo, et cetera. And then we've got capabilities around risk analytics, evaluation engine, process automation, issue management, reporting and dashboards, of course, a basic glossary, basic reference data. And then we'll sit on, your catalog of choice, whether it's IBM, Colibra, Informatica, Lation, Big ID, Trifecta, et cetera. Okay. So I'm going to stop there, and I'm going to turn it over to Alex.
Okay. Hi, everyone. Alex, CTO of Your Data Connect. I'm going to get started with a quick demo of the platform. This is YDC, and on the front page, we can see tabs for each of the 4 modules. So as Sunil said, the very first step in using our platform is to define those assets and liabilities around our data management program. So the result of that is the data balance sheet. Step 2, valuing of the assets. Now that we've identified the different data assets we have, plus we might want to value the impact of other things we're doing within data management, such as the risk reduction we create by better standards and policies around our data. So we value those data assets or those activities we're doing as data management professionals. That's step 2. Step 3 is taking a look at the risks around our data. So quantifying those. It could be through, as Sunil said, through something like a Monte Carlo simulation, which is a way of saying I have a set of variables which are going to expose me to some risk. And I want to quantify that. And I also want to know what's the reduction in risk in terms of dollars if I do things like implement data loss prevention software. So that can be represented on the balance sheet as well. Step 4 is saying, basically, I've gone through this cycle to identify assets, understand the value around them, and the risks as well. And now I want to list those on a data exchange within the company so that other divisions can get access to those assets and use them for their own business cases. So it's basically a way of sharing our assets within the company for a compounding effect on their value. So I'm going to start with the data balance sheet. This is a sample data balance sheet for a financial services company. And as Sunil said, the very first step is to capture that data management expense. So what is my investment in data management? So I've selected that account. This is a liabilities account, data management expense. And where does that value come from? We see there's a value of $281 million. That comes from what we call business use cases. That's where we actually define some variables around our data, and the outcome is a value. So in this case, I've added some variables around the data management expense to compute the net present value of my investment. So given $100 million investment per year at a 5% discount rate across 3 years, there's a net present value of $272 million. That shows up on the data balance sheet under that account, which is linked to data management expense. And I could have one-to-many business cases linked to an account. Now, that's the first step. Now we understand how much we're spending on data management. We've captured it here. And our next step is to make sure we're generating enough assets that explain what we're doing with that spend, and even go above that spend to generate, value beyond the investment in data management. So in this particular bank, I talked about you can value data itself, you can value the activities of data management as well. In this case, what this particular bank has done is they want to value some efforts they're doing around reports, applications, and database stewardship. So if I select, for example, applications, we can see there's a $28 million asset here. Where does that come from? So if I go to the Data Valuation tab, this is where we can understand at an application level, things we can do to drive value. In this case, we have an inventory of applications. In this, Sunil mentioned how we integrate with other systems. So in this case, we've integrated with an application catalog, an external catalog. We have a list of applications here, and we've defined some criteria around risk for these assets. So certain applications have a criticality score. Some are high, some are medium, some are low. And for each one of these applications, we rank it by criticality score. And we've computed that there's a $2.8 million value around certifying these applications fully. What that means is there's certain activities I have to complete in order for an application to be fully certified. I have to identify data stewards. I have to identify critical data elements. I have to have data quality in place, data lineage, et cetera. After I complete all those activities for a given application, we consider it fully certified. The stewardship certification is complete. And then we realize a value. In this case, we can see for critical, there are 6 total applications in that category. We want to assign 10 criticality points for that score of critical. So we have 60 total points, but only 1 application which has been fully certified. So we realize a value in this case of $28 million. So that's a critical application. As we certify more applications, the way we've quantified it, we'll realize additional value, and that number on the balance sheet will go up. So this is a way of not valuing data itself. This is really valuing the activities, of a typical data management program. So we do the same thing for databases, for reports, critical data elements, and so on. Going back to the balance sheet, just a few other things to take note of. We can define, multiple accounts at any time. We can have hierarchical accounts and so on. We can value data itself or the activities. Now I want to talk a bit about this unexplained amount. So this is basically showing the gap between our expense and our assets. So in this case, unexplained is positive, and that's actually a good thing. So what it means is, of the $281 million investment in data management, we generated excess value. So we've generated, in this case, $310 million of assets. So that's a $28 million in value we've generated beyond the spend. And ideally that number is going to continue to go up the more assets we generate and the more activities we do to increase their value. So I want to move on to risks now. Risks as well we can show in the data balance sheets. Monte Carlo simulation is one way of estimating some outcome given a set of random variables. In this case, we want to measure the risk of fines from GDPR due to a data breach, both before I implement some kind of control. So basically, given what I'm doing today, what is the potential impact on my company? And then there's things I can do to minimize that impact, such as implementing data loss prevention software. What would be the business impact after I implemented that software, reduce the chance of data breach, and what would the benefits be? So with the Monte Carlo simulation, we define those random variables. And for each one of these, this is fully configurable. We can have as many variables as we want. We have a mix of variables that are defined before I implement those controls as well as after. So what are the number of security incidents per year around data leakage? What is the likelihood of one of those resulting in an external data breach, and so on? If I open each one of these variables, we'll see there's going to be an upper and lower bound for each of these. It's between 0 and 3%. Some of these are currencies, some of them are percentages, some are numbers. For example, the cost of external data leakage incident per record impacted is another variable. So after we define these variables, we can basically simulate this a certain number of times, 10,000 times. Random values we generated for each one of these variables, and then some aggregates are going to be performed on the 10,000 rows. So in this case, what is the business impact before controls? It's the average of variable F. If I pull up F here, we can see that it's a computation between some of the other variables. Also, what's the business impact after controls? That's the average of variable I from above. Variable I is basically factoring in our incident reduction rate by implementing data loss prevention software. And also it's taking into account the cost of that software. So what's the overall reduction in risk by implementing that data loss prevention software as well? So those results are computed here. These can roll up to the balance sheet as well. We also plot the results visually over here. This is a loss exceedance curve. What this shows is the red is the business impact before controls. So let's say, for example, a 50% probability of a data breach, the business impact is going to be around $175 million or greater. If I implement the software, it's estimated that the impact after controls, the blue at 50%, would be more around $50 million. So an obvious reduction in risk. That is, risk again. So moving on, Monte Carlo could also be used to estimate the value of data. In this case, I'm looking at a balance sheet for life sciences. These balance sheets, you might want to have different balance sheets across divisions. So this balance sheet, we have a R&D division with clinical trials data. Give it a minute. So this clinical trials data, we estimate it with a Monte Carlo simulation as well. So let me explore to find that. So our knowledge graph here has found this clinical trials data evaluation model. Again, we have a number of inputs for estimating the value of clinical trials data and some outputs. And that's just one way of, it's very similar, right? I have cost of a phase 3 oncology clinical trial, probability of success, gross margin. I can simulate these variables to compute against some outputs. What's the min, max, and average value of that clinical trial given this data? So with that said, Sunil, I'll turn it back to you.
Thank you, Alex. Any comments, Doug, before we just launch into the Q&A portion?
No, this is really impressive because you're looking not only at actual value, but you're looking at probable and potential value. The application of Monte Carlo is something that is drastically underutilized in valuing anything. So definite credit to YDC for coming up with this methodology.
Yeah, I think trying to nail an exact number for evaluation is hard, but if you give people ranges, especially in finance, you just have more credibility. Yeah,
and for me, as a data strategist, I'm kind of more interested in the delta. How are those numbers moving over time? This shouldn't be a one-time exercise. It should be something that you're doing periodically to look for degradation or depreciation or appreciation in the asset's value.
Excellent. So then, without further ado, Doug, what I will do is I'm going to launch into some questions.
Oh.
The first question I have for you is, in your vast experience, do most companies have a data monetization program?
So formally, no, but most companies have some kind of effort underway to, either become more data driven or do more with their, analytics, to the extent that they're actually measuring the contribution of data to those new value streams. No, probably not. Most are not doing it.
Okay.
No.
Related question: do you see any specific industries, sub-industries that are more advanced than others in terms of data monetization?
Those that are in non-regulated industries tend to have less of a gauntlet to run through when it comes to monetizing their data. So if you're talking about banking or government, obviously due to the Freedom of Information Act in the U.S. and similar regulations in other countries, you really can't you're a bit restricted in how you monetize the data. Energy companies and others that are in highly regulated industries, healthcare, are finding it more difficult to work through the challenges of monetizing their data, even though those challenges may be perceptual, not actual.
Okay.
Yeah.
So Doug, who owns data monetization? If there's a company that's actually doing data monetization today, what role owns data monetization, or if nobody owns it, who's in the best position to own it going forward?
Really should be owned by the chief data officer. I know there are people like Bill Schmarzo who have called for a chief data monetization officer. I think that's a little bit overboard, but I wouldn't mind it. But I just think that the concept is a bit overboard for most organizations. Data is an enterprise asset, as we've talked about. It shouldn't be owned by any department or individual. There should be trustees assigned, yes, but not owners. And to that extent, the CDO is the chief steward and caretaker of the corporate data assets, and therefore should be the one who's setting up a data monetization initiative. He or she may not run it themselves, but perhaps somebody under them is doing that. But it needs to be formal, and it needs to be run like a product.
Yes.
Yeah.
So what we've seen, the data so certainly the CDO needs to own it.
Mm-hmm.
It's not clear if the data governance team actually has the bandwidth to actually own data monetization as well. So we've seen a new role emerging called a value realization lead. It could be a data monetization lead, but somebody who reports to the CDO who's responsible for realizing value. So you have a data governance team that's actually doing the work, right? Building lineage,
Mm-hmm.
data quality, stewardship. But you've got a value realization team, frankly, who's counting, working with the business to identify more use cases, catalog them, and drive buy-in, especially from finance.
Mm-hmm. Yeah, that would be fine. I mean, whatever fits into an organizational structure. I'm not real doctrinaire about that, but and it might be something that's led by one particular business unit. Say, maybe marketing has some ideas on how to monetize their customer data in some innovative way. Well, great. Go run with that if you have some enterprise initiative already underway.
Excellent. The next question, sort of related to the earlier comments, were what are the best practices to get finance sponsorship for data monetization? Given finance frowns on something that's not GAAP compliant or IFRS compliant, how do you get finance on board?
That's a great question, and we dealt with this in a couple of earlier sessions this week, where I think the basic answer is have that conversation with your CFO, and I guess there are a lot of CFOs who are busy playing defense, focusing on compliance, and others who are looking to drive value for the organization. So if you're lucky to have one of the latter CFOs, and even the former, have the conversation and say, listen, I understand data is not a balance sheet asset yet. Hopefully someday it will be. But that doesn't mean we shouldn't be treating it like one. We're in the midst of the data economy, the information age, the digital age, whatever you want to call it. And for us to not be paying attention to the potential and actual value of our data assets is a tragic mistake. In fact, investors, are starting to look at companies that are look at the data value of companies. At West Monroe, we work with private equity firms and advise on hundreds of deals a year, M&A type deals. And the investors are, starting to ask questions. And one of the reasons I joined West Monroe is to be able to answer these questions around what's the value of this company's data worth if we're to bring them into our portfolio, or if we're to integrate these two companies, what's the added value in terms of the data that they bring, and is the data consistent or inconsistent from one company to the next, and what are the monetization possibilities should we should we execute the transaction. So I think one way is to have conversations with your investors. Okay, another way is to have the conversation with the CFO and say, listen, I understand data is not a balance sheet asset, but we want to start treating it like one, and there's every good reason to do so.
So another interesting point here, and this is public information. So last year, during the height of the coronavirus, right, a lot of the airlines were cash strapped and they were looking for sources of funding. And many of the airlines, American and United being public examples, they actually pledged their loyalty programs. The American Advantage, United Mileage Plus, they pledged those to the banks and they raised money against their loyalty programs. If you think about it, the
And
loyalty
not just a little
program
money.
a lot of money. So American Airlines, and this is public, there's an SEC, Securities and Exchange Commission Form 8K, which lays out in gory detail that United Airlines believed at that time, last year, during the height of the virus, that the value of their Advantage program was between $19.5 billion and $31 billion. That was the loyalty program. The value of the loyalty data is a large percentage of that number.
Right.
And it's from, so the point here is the value might have been actually higher than the value of the airline itself at that point.
The value
That's the
of
point you're
American
making.
and United Airlines were $8 billion and $9 billion respectively, and the valuation they got for their loyalty programs was a 2 to 3x multiple of that. I wrote an article in this on Forbes if anyone wants to check it out.
There you go. There you go. Exactly. So thank you, Doug. So then the another question I have for you, and then we can turn it over to the audience. Will we ever get to a point that companies report on the status of their data assets similar to ESG reporting?
Yeah,
starting to see companies doing ESG reporting, right? And what about value of data?
So there's a certain PR benefit to doing ESG reporting, right? And I don't think that there's a similar public relations benefit to reporting on the value of your data assets. The public in particular looks askance at companies that hoard and aggregate data, I think. And until there's really a compelling regulatory reason.
Did we lose Doug again?
I think he froze up. We can take some questions from the audience, Sunil, if you want.
Sure, let's do that.
All right, a number of questions have come in. There was one comment and a reply to that said, in the near future, the visionaries with foresight will be talking about how once upon a time, businesses thought spontaneous generation was the same as data always existing without intrinsic value to be measured as an asset. Then again, it might take quantum computing to fully measure the perpetual value of data is being measured. The future is bright. And then the reply to that was I love this session. I'm a CPA by training, so can relate to what you're proposing. I am now in data management role. Have you ever monitored data for a utility, electrical utility? Would love to hear about it.
Yes, so I can answer that question. So question was, have you ever valued data for a utility? So the answer is, think about smart meter data, right? So those of you who worked in utilities, smart meters are essentially appliances that are in people's homes, and they gather the utilization of electricity every 15 minutes, typically, if you're commercial, or every 60 minutes if you're residential. The idea is that the utilities want to incent you to use your washing machine at night. So they don't have to build a power plant, a costly coal-fired power plant for the 2 hours in the summer when there's peak utilization, right? So that's what a smart meter is. So they're generating all this so-called interval data, but how do you value it? So as Doug said, there's different ways that you can value data. But if you're looking at smart meter utility data, you say, okay, is there a comparable out in the industry where the value of a company is just focused on the value of interval data? So there's a company called InnoWatts, 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 and I think they raised Series B funding. So anyway, the short answer is if you go and actually look at InnoWatts and do some analysis, and make some assumptions, you get to the point where you say the value of interval data per customer, I can't remember now, it was like $4 per customer. So the answer is there's interesting ways that you can value utility data or telematics data looking at comparables. So much like if you're, one way, as Doug said, is to do a bottoms up. You look at all the value being generated from different business cases. The other way is tops down. So it's the same way, if you're valuing real estate, you're valuing a house, you could say the value of the house is the discounted cash flows from potential rental. Or you do a tops down aggregate way and you say, I'm looking at Zillow. I want to see properties with comparable number of bedrooms or bathrooms, and what's the valuation. So an aggregate methodology is to say, are there companies that are pure plays and all they do is this type of telematics data, whether it's smart meter data or vehicle telematics data, and you could do a valuation that way.
So similar question on the impact of data monetization on healthcare delivery system.
Impact of data monetization on a healthcare delivery system. We've done some work with a few different healthcare organizations. We actually built a data balance sheet recently for a company that is both a payer side and a provider side. So on the payer side, we've gone through, and Alex did show this to you, but we've got the concept of customer lifetime value. So you could actually value, if you're a member on the payer side, health insurer, right? Cigna, Humana, whoever it might be, you can actually value a member. You could say a member, you pay so much in premiums, there's so much in claims, that there's a cost to serve, and there's an attrition rate. So you actually have, then you do a discounted cash flow over 36 months, and you say, this is the lifetime value of a member. That's the value of your member. And you can actually put that on your data balance sheet, and then you can drive a next best action to say, for my top 20% of members with high value, I want to have a nurse practitioner check in with them every 6 months. That would be an example on the payer side of healthcare. On the provider side of healthcare, we did some work last year with an organization at the height of COVID-19, and they were looking at using telehealth codes and doing governance around telehealth codes to explain to patients why they should be using telehealth to actually get discretionary services, right? So that would be an example of using your telehealth reference data and driving activity in terms of revenues.
All right, last industry request here, oil and gas.
I'll turn it over to Doug. Doug, I don't know if you've got any comments, questions.
Yeah, there was,
on oil and gas.
let me see if I'm back on. Yeah. So there was an interesting story. There's an energy company in Indiana, MISO Energy, I forgot how it's pronounced. And one of their senior architects used some of the data valuation models that I published to identify data assets that were costing the organization more to collect, store, secure, manage, et cetera, than the value that they were generating. And so they made what's called another assets classes, a defensible disposal decision, and are now saving millions of dollars a year in unnecessary infrastructure costs by having disposed of that superfluous data.
Okay, Doug, now that you're back, I didn't know if you want to continue your thought there, or we can keep asking questions from the audience, of which there are quite a
No,
few.
go ahead. Keep
Yeah.
asking questions.
What was that? Here's one. How do you distinguish between a recurring benefit and a one-time benefit?
Recurring benefit and a one-time benefit?
Yeah, in terms of the value of data, do you measure that differently or
Yes,
not?
yes. So at least in our methodology in YDC, we translate everything into what is called enterprise value, and we define enterprise value as the value of your equity, so stock price, plus long-term debt minus cash, which is any private equity firm and they're valuing companies, that's what they do. And the reason we do that is when you have data monetization, growing revenues, reducing risk, improving cash flow, reducing cost, those have differing impacts on your stock price. Does that make sense? So we normalize everything back to enterprise value. The point I'm saying is, in that methodology, a recurring benefit is going to have a much higher impact on enterprise value, stock market value, versus a one-time benefit.
Yeah, when I did this with the pharmaceutical company recently, did a valuation of their data assets. We looked at again, not only the actual uses of the data, but the potential uses of data and what was that potentiality, and then what kind of revenue stream or expense savings would that generate on an annual basis, and then translated that into a net present value from that cash flow.
Yeah, Sunil, I have a question for you. We actually got approached by a private equity firm that wanted us to help them evaluate a potential acquisition's use of data and value of data. We probably should refer him to you because I don't think we were going to meet his needs in the time that he wanted. Now, my question is, how long does it take you to do an assessment or evaluation of a company's data value or create a data balance sheet?
Alex, I'm going to ask Alex that. How long? 2 days, Alex? Right?
Yeah, within a week, absolutely.
All right.
So what we do, I'll show you, I'll give you I'm going to actually just go to right here. I'm just going to yahoo.com. So let's say I've got Ford Motor Company right here, right? So I didn't make these numbers up. These are Ford Motor Company's numbers. So if you go look at statistics for Ford Motor Company, I see market cap, I see enterprise value. So enterprise value is basically market cap plus long-term debt. Then I see enterprise value to revenue, enterprise value to EBITDA, which is basically adding back interest. All these numbers are all here. So essentially what we do, and this is what private equity, what resonates with private equity, right? That you're thinking about these numbers, that's what they care about. So what we have in our platform, which Alex and his team built, we've actually got an integration with the Y Finance API, using Python. And we bring all these metrics into the platform and you can easily reuse them in your valuation.
All right. Well, we'll get together afterwards and I'll make an introduction. I think that
Thank you. Thank you,
could use you. Yeah. All right. Let's go back to some questions. How does the model handle the value of algorithms? That's an interesting question.
Wow, that's a great question. How does model value algorithms? So anything around information is an asset. So Alex showed you in the balance sheet for the bank, he showed you applications, he showed you databases, and he showed you reports, right? So with this particular bank that we were talking about, it's very simple. They had to comply with the LFI, the Large Financial Institution Rating System in banks. What that says, the feds will, if you don't reach a 1 or a 2 rating with the Fed, they will tell the bank you cannot pay a dividend, you cannot buy back stock, or you cannot make acquisitions. It's as simple as that. So you can actually put a value on that. You can say 5% of your value applies to it. So what we've done with the bank is we started out with their market value, what value applies to these financial regulations from the Fed, and you get right down to what's the value of report certification. So in banking, there's something called RDAR, report certification. The long and short of it is we went through that analysis and we showed the bank for every report that they certify, using whatever workflow capability, Colibra, Informatica, et cetera, right? There's $1 million in value that you add to your data monetization program. Now you could do the same thing for valuing an algo, valuing a predictive model. So one of our clients in the past was building a predictive model around what's the next best action around customers who are most likely candidates to invest in an IRA. So customers who don't have an IRA today, but are still employed, right? So they basically looked at, what was their employment status, what was their date of birth, what was their marital status, and they built a predictive model. And then they saw over time that they were able to drive more cash, more assets under management as a result of that model. So you can actually then build a model to say, if this model is going to drive so much assets, what's the margin that we get on those assets? And then that's the way you can value your model, right?
Yeah. So do you get any pushback, skeptics who just think that you're,
all the time. All the time. I'll be honest with you, right? I know I'm a vendor and I'm supposed to say, yeah, it's perfect. No, all the time. Because
what are the biggest things what are the biggest critiques that you get and how do you handle them?
I think there's 3 or 4 different types of critiques. One is, I think from data management folks who don't feel comfortable in this space. Let's just be honest, right? Because I think data monetization is disruptive. You've got to understand data. You've got to understand technology, potentially reg, but the key is finance. So I wrote a blog recently about how data management folks need to be more finance literate. So I think the first one is just an objection around this is not in our sweet spot. That's the first objection. The second objection would be this is too much work. I have to go with finance, I have to chase around, I have to go figure out how to value all this data. And there's not a lot of discipline around, and I'm making a lot of assumptions. So there's all this work involved, which is why we think you're going to need a separate department under the CDO who does that. And then the third one is, you know, is there discipline around it? How do you value the data? There's too much of guesswork, if you will, which is why we talk about ranges, right? So we don't think it's we think there's going to be adoption. There's an adoption process for data monetization. It's not like everybody in the world is going to adopt it, but at some point they will. You just Doug and I and the rest of the team have had a conversation. Go on LinkedIn and do a search on data monetization. You'll see a lot of people with data monetization in their title, probably double where it was a year ago, right, Doug? And it's probably half or 25% of where it'll be in a year's time. So yeah, we get objections all the time. And we just believe it's part of the evolution process around this discipline.
So why do you call it data monetization and not like data accounting? Because it seems more of the latter than the former. I mean, I've written reports on data monetization. It's all about how to make money directly or indirectly from data so that you can actually measure it using cost-benefit analysis. So maybe this is naive, but
no. First, you got to account for it before you can monetize it, right? So I would say accounting is a part of it.
yeah.
Mm-hmm. And I hear you, Wayne. A lot of people tend to conflate or confuse monetization and valuation. They're interlinked, but they're different. Monetization is about driving value, and valuation is about determining what that value is.
Okay, that's different than the way I've always used that term. But anyway, learning a lot here. Here's another question: should companies share their data balance sheets and report on changes?
I think we addressed that one already, unless I got cut off.
Yeah, I think you got cut off, Doug.
The basic answer there is, why would any company want to report on more publicly than they are obligated to do? It's an advantage to organizations to hide what data they have from prying eyes of competitors and so forth. Maybe they want to share that with their investors or potential acquisition suitors, but other than that, think about it. If you're a CFO or a CEO, raise your hand if you really want to report on more publicly than you're already obligated to do.
All right, so here's another question. Does this discuss about the investment into data, anticipated ROI and KPI showcasing business value or other aspects of data outcomes? I think the question is, when your typical data manager talks about the financial value, they're thinking ROI and KPIs and maybe anecdotal data.
So fair enough. So in our model, right, in YDC, think of it as a data model. So we've got an enterprise data balance sheet, and it rolls up multiple divisional balance sheets. You might have multiple divisions. Each divisional balance sheet will have a chart of accounts. For example, I would have customer, right? And then customer potentially has a number of use cases where the value of those use cases roll up into customer. So that's the way we go. We go with a business case, rolling up into an account that rolls up into a divisional balance sheet and rolls up into an enterprise balance sheet. And there's some nuances, but that's the way to think about it.
Yeah. How do you distinguish between static or dead data, something dynamic, data in motion, in order to establish the alpha of value add created on the balance sheet?
Wait, what?
Yeah, I think he's talking about data in motion, real-time data. Do you have a valuation of that?
Well, data in motion is what generates realized value. Data that's just kind of sitting there is more of a cost than generating value, but you can still value it at its cost basis. So I'm not sure if that answers the question. I like to use the cost basis of data as a baseline for what kind of margin you want to generate on top of that. Right? Just the same with any other asset. What did it cost you to create that asset or manage that asset? and then you want to generate some margin on top of that.
Measuring risk and liabilities, who would have responsibility for that?
The ultimate owner for data monetization in general, most likely, as Doug said, is the chief data officer. For measuring data risks and data liabilities, and the difference between inherent and residual risk, I'm sure your risk department would be a key sponsor, or the information security team, some combination, would be sponsors for that particular use case.
Here's a comment from someone in the government sector. He likes the approach, but he says, I'm skeptical of our ability to produce the data required to accurately value it. How do we know if we are ready for this? How do we get ready for this?
All right, that's a good question in government. So in government, you don't have, the concepts we've used are commercial concepts, right? Enterprise value, stock market value. So in government, you would use budget. You'd use the budget, right? The annual budget as a proxy for how you would do data monetization. I don't know if you want to add anything to that, Doug.
No, I mean, in government, there are situations where you want to use data to generate revenue, right? But otherwise, you're kind of limited in how you're monetizing data. But you I still think you should go through the same exercise for sure.
All right, so I think we're coming close to the end of the time. One last question. Is this only looking at data, or also the machines, systems that make the data and do require maintenance?
Well, sure, and those are physical assets, provided that you own them and are not leasing them or using the cloud. That's the difference between CapEx and OpEx. So that's part of the overall value equation, but I guess I'm not sure what the actual question is here.
Yeah, well, anyway, we have run out of time. So,
okay.
I don't know if you want to summarize your panel and final remarks. That would be awesome.
Awesome. So I just wanted to thank Doug and Alex for their time. I think this was an enjoyable conversation. And thank you, everybody, for a great chat.
Thanks, everyone. Take care.
Bye.